We're going to get started here. So my name is Kory Henn, and I'm an associate here at Concrete Ventures. And for the next about 30, 45 minutes or so, we're going to be talking about how to research investors for your fundraise. So if you've never raised capital before, this is a fantastic session to get you started. Or even if you've raised a little bit of capital in the past, but now you're going out and maybe doing that first big institutional round, then this will be great for you as well. But first, I want to talk a little bit about Concrete Ventures. So we are an Atlantic Canadian-focused pre-seed venture capital fund investing in technology-based startups throughout Atlantic Canada. So we focus on finding founders who are ready to build massively scalable businesses and work with them to bring those visions to reality. So for today's kind of session, we're going to talk about 5 key things here. We're going to talk about the importance of investor research. We're going to talk about the 4-step process of researching investors. We're going to talk about where to store that investor list and some key considerations to think about as you do that. We're going to talk about some tips for getting into touch with different VCs, and then we're going to talk about how to build quality relationships. Now, at any point through the session, if you have a question, please use the Q&A feature here on Zoom at the bottom of your screen. We'll go through everything at the end, but if something comes up halfway through the session, please drop it in the Q&A, and then that way, once we get to the end of the session, we have a nice list to go from right there. So let's talk about the importance of proper research. So researching investors is much like prospecting for customers in the sense that the key to a successful fundraise, just like the key to a successful sale, is a high quality pipeline of investors who are the right fit for your business. And we're going to talk about what that means in a few minutes. But focusing on building this type of pipeline will help increase your hit rate on cold outbound. If you're reaching out to the right people will reply back to you, and it'll shorten your overall fundraising timeline, right? You don't want to be chatting with folks on these intro calls or email back and forth if they're just not going to be a fit, right? You know, we get a lot of cold outbound here at Concrete sometimes from folks who you can tell they maybe haven't done their research up front and it's just straight up not a fit. Maybe they're raising money in Europe or they're looking for a big Series B investment. So it's important to do the research up front so that you know who you're reaching out to and you know that they're going to be a fit. So how do you determine if an investor is going to be a fit? There's a simple 4-step process. I'm going to talk about each one of these steps, but just briefly, you know, the first thing is going to be about creating your investment profile, right? A checklist to quickly evaluate fit, right? Understanding your data sources and just start screening investors, right? Keeping in mind that the quality of folks you're putting into your list is much more important than quantity, right? You want to disqualify investors based on fit, right? There's nothing wrong with saying this person is not a fit. I'm going to remove them from the list, right? And you do that using your investment profile from step 1 here. And then you want to double down on the investors who are a fit, right? So start collecting more information, add them to your list, and really double down on those folks before reaching out. So let's start with creating your investment profile. So what is this? Every single investor has certain criteria that they evaluate opportunities against, right? And this is before we even start talking about the business itself. So these criteria don't take into account like your business model, your team, your product, your value proposition. None of that is relevant until we first determine, is this an opportunity we could even look at, right? And every VC has different criteria in terms of what structurally works for an investment. But the broad strokes are what we see here on the screen. So things like stage, the sector, the size of the round, and the check size that you as an entrepreneur might be looking for. Whether you're looking for a lead investor or just a syndicate partner, not a lead investor. And then geography. So for example, here at Concrete Ventures, we invest in pre-seed and early seed companies. So if you're looking to raise a Series A, we're not a fit. Right? We'll evaluate all sectors, but with a bias a little more towards internet and IT businesses. But, you know, but some funds might be fintech focused or they might be ag tech focused. So if there's not a sector fit, then there's not a fit at all, right? We have an average check size of like 250 to 350K, for example. So if you're looking for $1 million check, we're probably not the right partner for you. And then we're happy to be a lead investor or syndicate partner, but some firms are a little more strict about this. Some firms might only lead investments. Some firms might only be a syndicate partner. And then lastly, geography. So we invest exclusively in Atlantic Canada. So if you're in Europe or the States trying to raise some Concrete Ventures, we're not going to be the right fit for you. And this criteria is really important because if we go back to this slide, you could be the next Figma, if you will, that we all know just got acquired for about $20 billion. And if you don't fit this criteria, it doesn't matter about the business, right? There's just not a fit. So how do you determine fit, very quickly. The best way I have found to do this is to build a checklist that you can use to quickly qualify investors based off of the criteria we just talked about. So in this example, let's pretend we are a B2B fintech company raising a pre-seed round of $750,000. So our criteria that we're going to be evaluating investors against is going to look a little something like what we have here on the screen. So we're going to be looking for firms that have made an investment in the last 12 months. We're going to talk about that a little later in the presentation. We're going to be looking for firms that invest at the pre-seed stage. We're going to be looking for firms that invest in rounds of $750,000. Now, the reason why we have this criteria in there is because round titles mean many different things to many different people in many different markets. Pre-seed in Atlantic Canada looks very different than pre-seed in San Francisco, for example. So if you find a fund that says they're investing in pre-seed, but they're only doing investments of $1 million or more, then there probably might not be a fit for your $750,000 round, right? We're looking for a lead investor. So we're looking for folks who will lead deals, and you can find that information relatively easily. We'll talk about that. We're looking for investors who can invest in Canada, and we're looking for investors who invest in B2B fintech. So every single time we're on a VC's website or we come across a firm, we're going to run this checklist. And if they check all the boxes, great, let's add them to our list. If they don't check all the boxes, it's important to disqualify investors who are not a fit, right? Remember, we're looking for quality, not quantity. So if a fund doesn't check at least most of the boxes, move on to the next one. Your goal is to quickly build a short list of investors who are worth diving deeper on. And mixing in the firms who aren't a fit based on your investment profile will only slow down your overall fundraise. Now, if there's a VC that checks a couple of boxes, and maybe not all of them, but you think there's a really compelling reason to reach out, then by all means, add them to the list and reach out. But that's more of a case-by-case basis, right? The goal of this criteria is to separate what an investor is looking for structurally from your business. Because like I said, the business evaluation comes a little later. First, we need to make sure that this VC can actually do an investment. So now that we've established what we're looking for in terms of investors that are a fit, where do you find investors? And there is two main categories of places you can find folks. There's online research and there's offline research. So we're going to talk about 5 little examples here in this presentation, certainly not limited to just these 5, but there's lots of different places you can find folks. So for example, online, we have Crunchbase, we have Visible VC, the portfolio companies of fitting VCs, which we'll talk about in depth. That's a really great kind of source that I like. A tool like Signal. And then obviously on the offline side, we have other founders and your own personal network. So let's start with Crunchbase. Crunchbase is a great tool because of their query builder. So this is the query builder here in Crunchbase, and you can almost tailor your search to your investment profile. So let's go back to our B2B fintech example, right? We're looking for venture capital investors who invest in Canada, who invest in fintech, and that invest in early stage venture. And we could get even more granular with this, right? You could narrow it down to round size, maybe even check size. The thing with Crunchbase is it's a database of VCs, but it's crowdsourced information and web scraped information. So you can see in this query, we have 248 results, but much of that might be noise amongst the signal, if you will. So it's important to narrow your search a little more and then kind of try to verify the information you see maybe on the firm's website or maybe in another kind of place. But Crunchbase is a fantastic place to start and really start quickly qualifying investors with your checklist. One thing I'll mention is Crunchbase. It's not a free tool. It used to have a really great kind of free program, but it's kind of gotten limited over the last little while. But if you're really serious about raising money, it's worth kind of picking up a paid plan and then using the tool to help find investors. A tool like Visible, very similar to Crunchbase in the sense that it's a database of investors that you can kind of filter based on different categories. So in this particular example, we filtered for pre-seed funds that invest in AI. And you can see we only have 103 results. But what I like about Visible is they verify much of the information. So the information you see about 360 Capital or Allied Venture Partners is verified. Visible went out and said, yeah, is this information right? And those firms said, yes, it is. So it's similar in the sense that it's a database, but there might be a little more signal amongst the noise, if you will. So that's just another example of a tool you can use. Now, one of my favorite ways of finding investors is the portfolio companies of VCs that are already a fit. So let's say you find a fintech fund that is a great fit for your B2B fintech startup. look at their portfolio companies, because for every investor that's a potential fit, usually the other investors who back their portfolio companies are also likely a fit, right? Fintech funds probably invest with other funds that invest in fintech, right? So you can look through the VC's portfolio companies. You can usually find it on their website under the portfolio page, and look for companies who are comparable, not competitive, right? Because investors won't invest in competitive companies, but are comparable. So maybe it's a similar value proposition in like a completely different market application, right? And then you can use a tool like Crunchbase, or you can use press releases or blog posts to find out who else invested in those companies and then run your process all over again, right? It's a great way to kind of find relevant investors pretty quickly. It's not a database approach, so it's a little more kind of manual, if you will, but I would say the quality you might get is a little higher. And then lastly, on the online side, there's another tool called Signal. It's another kind of database tool that uses LinkedIn and I believe your Gmail to try and find introduction paths to investors. So it's a little unique in that sense, but very similar to some of the other online tools we looked at, where you can filter by, whether sectors of interest, stage, lead investor, check size, things like that. And then you can get a list here. And then it's all about using your checklist to figure out who might be a fit very, very quickly. So now on the offline side, we have other founders in your own personal network. Now, this is something that I think is a great place to start. So other founders can be a great resource for getting leads on different investors. And one of the main reasons is because they can often provide a first-party reference on that investor as well, right? Because remember, investors are not just capital providers, but they're also business partners, right? You're going to be reporting to these people monthly, maybe quarterly, maybe just annually, but they're going to have influence on your board potentially. They're going to have influence in your future funding rounds. They're going to have influence on your business in many other ways. So you want to make sure that you're partnering with investors who are a right fit for you and for your business. So these first-party references from other founders are invaluable, right? And then just having a network of founders is helpful elsewhere in the fundraising process. They can provide insights into the investment process overall. So how many meetings did it take for them to get to a term sheet potentially? Or what kinds of questions did VCs ask these individuals? They can provide tips on term sheet negotiations, which I think is very valuable because previous venture-backed founders have seen how these negotiations impact the business 2-3 years from the time of the deal, right? And that's kind of what's really important. And then lastly, they can even help you refine your pitch based on past experience. So maybe you're focusing too much on the technology, maybe not enough on the value proposition or something like that. So they can help you kind of shift your focus in the pitch if you're not getting the results you're looking for. And then a good honorable mention back to the online side is a good Google search, right? Just sitting on Google and looking for investors can be a good time sink. But what's nice about it is you often find these content pieces related to investors. So you're not going to find a database with all the information you're looking for, like a Crunchbase or a Visible. But what you might find is 14 climate tech investors who share their first half 2022 strategies. So what you can look for here is, okay, here's the VC's name, and here's what they're looking to invest in on a climate tech perspective. And if that's a fit for me, I can reach out and say, hey, saw your piece in TechCrunch, really aligned with your strategy. I think there might be a fit here, right? And then sometimes you can even find lists on other sites. So the definitive list of clean tech and climate tech investors, which might have some different names than what you might find in, say, like a Crunchbase, or maybe it's a little more focused on the sector. But Google is, like I said, it's a great place to spend a lot of time. So it's good to get creative with your searches, and maybe you come across some interesting content that you can use to turn a really cold intro into a lukewarm intro, if you will. But it is a place to consider as well. So now that we have our checklist, and now that we know where to find investors, and maybe we already have a list of some folks who are a fit, what do we do with these individuals? What do we do with these firms? We want to enhance the profiles of the investors who check all the boxes. So we want to start going a few levels deeper beyond just the firm's name. So look into the team. Who is the best person on the team to reach out to? You can use a tool like Hunter to get email addresses. It's important to go through the bios of all the team members, especially for more generalist funds. So if you're looking at a generalist fund, okay, who invested in that fintech company? That's the person that I should be reaching out to. Sorry. And then, when you're enhancing the profiles, you want to be able to get a sense of check size. What other qualitative information can you find about this fund? The websites are a great place to start because it lists a lot of information that you're not going to find on Crunchbase or on Visible or on Signal. So things like I said, check size, deal preferences. Some firms even have an FAQ where they share a lot of insights about their process, about how they like to do things, about the best way to get in touch. So be sure to go through all of that before just sending a cold email to the fund. And then lastly, read into the blog, look at the content. Is there something relevant that you can use to make a connection? Like I said, if you can turn a cold email into a little more of a warm connection, like saying, hey, I saw this blog post you did on the future of fintech, really liked A, B, and C. I think we're aligned with one of these things. Maybe we could have a discussion about that, right? So it's all about enhancing the profiles of these investors so that you have a better sense of who you're reaching out to. So now that you've done that, but before you even do that, you have to have a place to store all these investors, right? Where are you going to put all this data? I haven't seen a single best practice. I've seen success across a number of different tools, everything from Excel and Google Sheets, which might be the low-hanging fruit. But if you're already paying for like a HubSpot or a Pipedrive, like a standard CRM tool, you can certainly use that as well. There's lots of focused fundraising tools out there, whether it's Visible or PaperStreet, for example. I've seen those. And then there's even a tool like Airtable, which maybe has a little more functionality. That might be good as well. So in terms of some considerations, I guess before I get into that, the first thing to think about when you're looking at these different tools is you want to pick something that works for your workflow. You're going to be spending a lot of time, in this tool, managing your fundraising process. So pick something that you can easily use, that integrates well into your day-to-day, and that isn't too far-fetched, that you're kind of, it's out there in kind of your peripherals, if you will. So some considerations to think about when picking kind of where you're going to put this investor list is you want to make sure wherever you store this information allows for easy updates to status changes, to things like communication. Did I reach out to this firm? Do I need to follow up with this firm? Have they not replied yet? Figuring out where you are in the funnel or keeping track of that. Did I have the first meeting? Do I have a second meeting coming up? Did I have a partner meeting, awaiting a decision kind of thing? Tracking feedback is something else that's also very important. Maybe firm X passed citing concerns around the competition. And in isolation, that's fine. But if you have 3 to 5 firms all saying, oh, the competition's a little, tough for us, maybe it's something to think a little more about. So you want to be able to track that information so you can get a sense of what trends might be coming up or what a number of different folks are saying. And then more on the positive side, you want to be able to track commitments. So a lot of firms who maybe won't lead a deal will say, okay, yeah, we're in for 300K. You want to be able to track these commitments. And then when you're talking to lead investors, you have that information ready. Or when you're moving to close a deal, okay, these people are all in. This is for how much. We're not oversubscribed. Or if we are oversubscribed, how are we going to navigate that? Or are we short on the round, right? You want to be able to track commitments and have a really good sense of that, right? Action items and next steps. So, because you're probably going to be having a lot of meetings, running this process every single week, every single day kind of thing, an easy place to store your next steps is critical. So do you need to provide a data room to this investor? Do you have to update the financial model? Do you have to answer the Q&A document that they're going to send you? Where are the next steps, whether it's on your side or on their side, and you have to be able to keep track of that. And then lastly, your own personal thoughts. So kind of as we alluded to before, investors aren't just capital providers, they're business partners, right? They're people that you're going to be interacting with quite frequently. So write down, did you connect really well with a particular investor? Or maybe there was an investor that wasn't quite a fit for whatever reason, right? You want to be able to track these things so that you can kind of start to move forward with the folks that you really like and that you really want to work with as well. So with that, how do you connect with investors? And so running a fundraising process could be a whole webinar topic on its own, right? There's a lot that goes into it, but we're going to cover off a few kind of key elements of it right here, right now. So I think the important thing to start with is the timeline of a VC fund. So your typical fund is 10 years in length. The first 5 years are for new investments. The last 5 years are typically for follow-on investments and exiting investments. So if you recall, the first checkbox in our checklist was looking for firms that have done deals in the last 12 months. And the reason why is because you want to be raising from active VC funds, right? If you try to raise money from a fund in year 7, they're not going to have any capital to deploy, or maybe they're in the middle of raising another fund and they're like 2 months away from being able to deploy capital. So you can often find out where a fund is in their cycle on Crunchbase, on the firm's blog, or in the press. They're never going to say explicitly where they are in the cycle, but you can just look to see like, when was the last investment announced? If it's been 2 years since they've done an investment, it's unlikely that they're actively investing. But if it's only been like 2 months or 3 months, then yeah, they're likely actively investing. So I think a good rule of thumb is if they haven't done anything in the last 12 months, it's not very likely that they're actively deploying capital. Now, as we kind of alluded to before, if there's a really compelling reason to reach out for a particular reason, then feel free to reach out and figure out what's going on. Maybe they're just not actively deploying out of a fund. Maybe they're investing some other way, or maybe they're not investing at all. But it's important not to spend time reaching out to folks who haven't done anything in the last year or so. So once you figure out, okay, this fund is actively deploying capital, how do you get in touch? Warm introductions are a fantastic place to start. And they're probably still by far one of the best ways to get in touch with an investor. They're always well received by VCs. Usually it can bubble you maybe to the top of the inbox or the top of the to review list, if you will. And you would be surprised how many VCs are second-degree connections on your LinkedIn, right? So back to our enhancing profile kind of discussion earlier, when you're finding the person you want to reach out to and you grab their LinkedIn, check to see if you have any mutual connections. You probably do in a lot of cases. Then see if there's a way you can get an introduction there. Or if you don't see anything on LinkedIn, ask fellow founders, mentors, or advisors, because perhaps they have an introduction path for you and then they can really help you. But the thing with warm introductions is it's always important to go beyond your own network. And that's where cold emails come into play. So cold emails, they work, but they have to be great cold emails. We get a lot of cold emails here at Concrete, and I would say the majority of them just aren't a fit because people don't do their research up front, right? You need to demonstrate very, very quickly why your startup might be a fit for that particular investor. So go back to your checklist, right? Maybe in the first line, you say, hey, we're a B2B fintech company located in this geography that you invest in, raising this round that you've done before, or the size of round that you've done before, and then a quick blurb about the company. And right away, you've demonstrated, okay, yeah, structurally, this is a company that is a fit for us, right? And now we can talk about the business. Now we can evaluate the business itself, right? I'll find a lot of the cold emails I get fail to do that first step, demonstrating fit, right? They go right into the business with like a page and a half about what they're building and what they're trying to do. And then I almost have to work to figure out if the company is actually a fit or not. I have to jump on LinkedIn or the website, figure out where they're based, figure out, what their last funding round was. And I find out it's a Series A company based in France. And it's like, well, okay, that's not a fit for us, but that could have been the first line, right? And ideally, that entrepreneur might have done some research up front and figured out, okay, yeah, Concrete Ventures isn't a fit. So when you're doing these cold emails, a good way to turn a really cold introduction into something a little more warm is trying to find some common ground to connect on. Maybe there's a recent blog post that the investor published. Maybe there's a tweet thread you found insightful or a talk or webinar that you attended. And mentioning this stuff in your cold email, hey, I saw your blog post on, the future of kind of working from home, if you will, or remote work. I thought it was really interesting. I really liked A, B, and C. I think our startup kind of addresses some of this stuff. And then you can get into kind of your cold pitch, if you will. So that kind of helps, warm things up a little bit on the email. And then lastly, I think it's worth mentioning that investors can tell when you use an email tool to mass send cold pitches. I get the efficiency side of it, but it's not personal and it's not relevant. And I would say 99% of those emails are just going to go into junk or get deleted. So it's important to remember that you want to reach out to these folks. So do your research up front, make sure it's relevant because you want them to reply, right? If you just cold email like 1,000 investors, you don't know who's going to reply, right? It might be people that you don't want to do business with. So how do you kind of navigate that? Because you're the one that reached out, right? So it's important to personalize, keep it relevant, and I'd avoid the mass email tools. It's not to say you can't be efficient in the process and have kind of templates and stuff, but be sure that you personalize and make it relevant. That's really important. So in terms of, you get in touch, you send that cold email, how do you build the relationship? So we always like to say, you should be reaching out to investors 3 to 5 months before you actually plan to raise. Great VCs will invest in building the relationship if there's a strong fit. And the way that you can continue to build a relationship is through sending monthly updates leading up to the raise. So the reason why this is important isn't just for the investor, but it's also for you as the entrepreneur, right? Because you want to get a sense of how these people are like to work with. right? It's tough to get a sense of that if you meet somebody and then 2 weeks later they're invested in your company, right? Because that commitment is multi-year. But if you invest 3 to 5 months in advance, maybe you figure out, okay, yeah, this individual really kind of replies to my updates. They have good advice. They've provided me with some decent kind of help on the asks that I've had. Or maybe this investor over here hasn't replied to my updates at all, right? And maybe they're not the kind of person that I want to work with. Maybe they're just more interested in the information and optionality, if you will. So it gives you a chance to see who is stepping up to the plate before they're even invested in your business. And then once they invest, then you know ahead of time, okay, they're going to be a great person to work with. There's a saying that I like, which goes, investors invest in lines, not dots. So these updates continue to build rapport. As an investor, we get to see, is the company kind of executing on their milestones and their roadmap the way they said they were going to? Or if not, are they honest and upfront about maybe what went wrong and how they're going to fix something, right? So it's both sides, right? Because at the end of the day, like I said, investors are business partners, but to us, entrepreneurs are business partners, right? It's a two-way relationship. It's a two-sided street. So it's important to kind of manage the relationship and keep things going over time. So we're already at the recap slides. This was super quick, so we can have some discussion here in the Q&A, but just kind of summarize everything we've talked about in 2 slides. You want to start your process by building your investment profile. That was the checklist we talked about. This will narrow your search and let you focus on the investors who are already a fit, right? And be sure to disqualify folks who aren't a fit very, very quickly. Build your investor list using a combination of both online and offline research, so networking with fellow founders, and don't just rely on one data source. The benefit of the investment profile and that checklist is that because you can disqualify folks very quickly, you can cast your net as wide as you want, because maybe you'll find those interesting firms in the pockets of the internet, in the pockets of your network that might be a great fit. And you have the ability to disqualify folks who aren't a fit relatively quickly. So you don't have to worry about spending too much time in the wrong places, if you will. And then lastly, use a tool that lets you keep track of your fundraising efforts. It's important to stay on top of the process. A lot of people say, and it is true, fundraising is a job on top of a job. So like I said, find something that integrates well with your workflow and find something that you're comfortable spending a lot of time in, that's not going to get too complicated as it grows in size. For the investors who are a fit, do your research before reaching out. Personalization of relevance is key. Yes, it's a little more work. It's very manual. But at the end of the day, like I said, you want to make sure the folks that potentially might invest in your business are the right fit, both from the investment perspective, but also from the personal perspective. Because remember, they're business partners. When it comes time to reach out, see if you have a mutual connection first. For those of you with like a LinkedIn Premium or Sales Navigator, you can see how many secondary connections you have, and you'd be surprised. It's a few thousand for all of us. There's lots of folks that know lots of folks that we have in our networks. So double check, see if there's an introduction path. But if not, cold emails work as well. Just make sure you show value right away. And then lastly, take time and invest in that relationship. Like I said, great investors will invest in it too. And that's really what it's all about. Reach out 3 to 5 months in advance of a raise and keep folks in the loop with those monthly updates. So we've come to the end of our presentation. Thank you again for taking the last 30 minutes right on the dot to join us and kind of learn more about this. I'd love to open it up to Q&A for the next little while, and we can kind of go from there. So I'll give folks a minute to put their stuff or their questions in the Q&A, and then we'll get started. We will certainly share the slide deck. You'll get that we'll send a follow-up email later today with the recording and the slide deck, and everybody can certainly have that. We have a question here. So beyond the corporate checkboxes, how do you suggest founders get under the hood with specific people that they're investing or that are investing? There are lots of horror stories, people getting deals that they think are good, but the investors end up being bad actors. What are your thoughts? The fantastic question. So early in the pipeline, when you're really just kind of figuring out the relationship, it's tough to figure out what do these people really like to work with, kind of to use your point, under the hood. Once you get to a point where you maybe think you're later in the process or near a term sheet stage, one thing I always suggest is reach out to that investor's portfolio companies. Get references from the folks that have taken money from these VCs before. They are going to be the most honest with you, right? Because they're not going to, if that investor hasn't been a great business partner, they're not going to be afraid to tell you that, So always reach out to an investor's portfolio companies. It's usually more efficient later in the process. You don't want to take an intro call, then spam their portfolio companies with kind of reference emails if the investment might not work out in the next 6 weeks anyways. But that's a great way to double down or to kind of reference check VCs. And then when it comes to the actual deal, having that network of other founders or people you trust to kind of take a second look at the actual term sheet and the way it's being negotiated and the way that you should approach it is always helpful as well. Don't feel like you need to go through the whole fundraising process solo. Always have people on your side. You obviously have your legal counsel, but also have other folks you trust that are in the industry that can really just provide you with the cold, hard truth if that's kind of what you need at times. Do we have any other questions coming in from folks? Any questions on the specific tools or anything like that? What kind of runway are you recommending these days, given the macroeconomic climate? That's a great question. Obviously the market has changed over the last little while, and the days of maybe raising money every 8 months are over. In terms of the actual runway, I always like to break it down in terms of how long is it going to take you to reach kind of the next milestones of your business that will make you investable again, or that will require you to raise the next round of financing. So if you look at your business and say, I think we can do this in 8 months and get to the next round, maybe you raise a little bit more runway. Maybe you raise 12 months, right? Because everything always takes longer than you think. If you look at your business and say, I think we're going to need like a year to do this, maybe you go a little wider, 18 months of runway or so. But it always comes down to how long you think it's going to take you to achieve the milestones that'll get you to the next round of financing. So when you're raising money, you always want to look one round out. If you're raising a pre-seed round, what's it going to take for you to raise that $3 to $5 million seed round? Look at the metrics, look at the numbers you have to hit, look at the way your business has to be growing, and then say, how long is it going to take for us to maybe achieve that? And then you can start to base your kind of runway off of that. It's a very floating number. It's not as cookie cutter as you might kind of hope it to be, but generally that 12 to 18 months is obviously the average that most investors would say. But certainly look at your own business, understand how long it takes you to kind of grow and progress, and then kind of base it off of that. We have a question. So what are the 2 to 3 most common mistakes founders make that they should not make or should avoid? I would say it comes down to the upfront research. That's the very, very quick mistake that you can often see. And that's without kind of getting into the actual business of the pitch itself. I mean, we could talk about that quite a bit on its own, but, not doing a research up front, sending cold pitches to VCs who just aren't a fit is a great way to kind of spin your wheels, if you will. Feel like that, okay, I'm doing all this work, I'm doing all this reach out, sending all these emails, sending my pitch deck to so many people, and then nobody replies. You don't get any meetings. And then you kind of wonder, well, what's going on? And in reality, it has nothing to do with your business. Maybe there's just not a fit structurally. So it almost gives you as a founder the wrong signal in terms of feedback. But if you're reaching out to folks who are a fit structurally, right, the right stage of fund, the right kind of investment size, the right sector and geography, and they're passing on the competition or other elements of the business, then that's a tough one as well. That's good feedback on the business, but at least that it's more so about the business itself. And because you're tracking that feedback in your tool, then you'll be able to kind of figure out the trends. Yeah. So Ryan Patrick kind of answered your question there in the chat, but yeah, Feedback VC is a fantastic tool. And then even just soft circling your materials or the pitch to folks in your network, especially other founders or maybe investors that you trust, to get a kind of temp check on how things are. Maybe your pitch deck is 30 slides and we can reduce that down to 15 and put the rest in an appendix or something. So Feedback VC is a great tool. And then also just your own network as well. So we have a question here. What level of traction will get a bite for a raise at pre-seed? I wish that was a simple answer. I would say the biggest things at pre-seed is the founder's ability to demonstrate that we can build the technology and we can get this initially to some sort of market, right? If you have the ability to build, ship, and then sell your product, that's generally a good place to start. And then it's all about the opportunity, right? Is this really a VC level company in terms of what you're trying to build and the opportunity you're going after? But it really starts with the team and the capabilities of the team to actually execute on any level of kind of milestones or roadmap. When you get into specific numbers, obviously numbers are fantastic. If you have a great growth rate and you're already selling product, you're already in market, that might be a little more attractive to investors. But you see pre-seed deals getting done pre-product sometimes, right? Or very, very early stage. So it really does boil down to the team and their ability to demonstrate that they can execute on some sort of roadmap that they're putting forward. And then there's all kind of the much more high level stuff that gets discussed later on. Hope that kind of answers your question. Okay, so we have a question. After researching a VC, we identified that they are in our space, are active. We cold reached through LinkedIn to the company and did hear back that they were closing a due diligence process with a similar company. Is there a smarter way to identify these issues earlier, or was this just a polite way for a VC to say that they would not like to move forward? So it sounds like, and please correct me if I'm wrong, it sounds like you reached out to an investor that was closing a deal in a competitive company, right? If that's the case, then that can certainly happen, right? And there's really no way for you to know who a VC is talking to or where startups might be in their funnel. I would say that it's likely they were closing, a deal with a similar company. If they just didn't want to invest, then they probably just would have passed and not said that. They could have, just used that as an excuse. But unfortunately, there really is no way to know who a VC is talking with and where startups might be in their due diligence pipeline. But that's also decent intel for you, because in the back of your head, now you can say, okay, in 6 weeks, I'm going to check that VC's website and see who maybe that new portfolio company is. Or I'm going to look on their LinkedIn and see, okay, did they announce that new deal? So that might be some decent intel for you, but it sounds like really just kind of a coincidence, if you will. So another question here, in terms of use of proceeds, what is an ideal split between sales and product development / advancement for early stage startup with limited traction? This is incredibly specific to your business. So we've invested in companies in the past where, all of the use of proceeds is going to development because maybe they just have to build the product first, or maybe the split between sales and marketing and development is a little more even because, okay, they got the product, they got the MVP or V1 developed, and now we're going to try and sell that, and we're going to kind of develop it on the side. So it really depends on what your roadmap looks like, how complicated your product is to develop, and kind of what the needs of your business are. I mean, in the early days, a lot of times you'll have founder-led sales for quite some time. So, you might not have like a sales team ramp up very, very early. Or if you already have a product in market that's already fully developed, maybe you do. So it really is very business specific. So we have a question. Can you speak to what companies should or should not disclose in their pitches and discussions to investors? Building on the last question, if you have a competitive company in the profile, you might just be free feeding your competitor specific info that you would not want disclosed. This is a fantastic question. And what I like to say is investors are in the business of confidentiality, right? So it's a tough scenario because you hear all the time, maybe there's VCs out there that do disclose kind of your information to their portfolio companies. But the great ones don't, because we are in the reputation business. And the second you do that and somebody finds out, there goes your reputation, and you're not going to get the best entrepreneurs that want to work with you anymore. So in terms of what you should or should not disclose, the thing I like to think about is startups are really all about execution. So you don't want to disclose like your IP. You don't want to disclose how your technology works or really kind of how you think about your competitive advantage. Now, you can talk about it at a high level, but you still want to provide enough information to an investor to say like, okay, this is the business and this is what we do, but maybe keep the secret sauce for a later date if that's what they want to get into. On the cold email, if there's a competitive company in the portfolio, the VC will probably just pass right away. If they don't, then that's a whole different discussion, right? But it's also important to go through their portfolio and see, is there a competitive company? But sometimes that can also be very challenging if you're talking with a very large fund that might have 100 portfolio companies. But I would say anything you're not comfortable disclosing, feel free to not disclose. VCs won't pass because you didn't disclose something. As long as you can highlight the business, what you're doing, the opportunity, and kind of the investment profile, then you'll likely get that intro call, and then you can get into the kind of weeds later on, if you will. So we have a question here. Please comment on your typical expectations and processes VCs use to validate founders' ability to reach an MVP. It's a great question. So let's assume we're a SaaS business, a simple kind of software business. Are the founders technical? Do they have kind of the technical capability to actually sit down, write code, and build the software? If so, that's great. There's really not like an evaluation process of it a lot of times. Like we're not going to do like a coding test, but maybe you were a software developer at a previous company, or maybe you just did like your computer science degree at a university and you've kind of built some code already. So it's really just like looking at the technical ability to actually build product. If you're in the hardware space, do you have experience building hardware products, or are you starting right from scratch? That's generally the way we look at evaluating a founder's ability to reach MVP. And then in terms of their ability to execute against a roadmap, that really comes into play because you reached out 3 to 5 months in advance, and then we kept in touch over time, right? So that's why you want to reach out early, is so you can demonstrate like, okay, yeah, we can do what we say we're going to do, right? And then you can kind of it helps investors build conviction that way as well. But it really does come down to just looking at almost the resume of the individual. Do they have the ability to actually build their product or sell their product if you're more in a sales focused role? So we have a question here. When sending a cold email to a fund, what documents, if any, do you recommend attaching to the email? So there's a lot of different camps that people are in here. Do you send the pitch deck? Do you not send the pitch deck? Do you send like a teaser deck? Do you send a one pager? And it's really up to you. But to think about this, because you've done all your research in advance, because you know that this fund is a strong fit, if the VC wants to continue, the first thing they're going to ask for is a pitch deck or more information, right? So if your deck is light on maybe sensitive information, maybe you can just attach that to the email and away you go. Or maybe you do a one pager, right? Here's the business. Here's kind of what we're doing. Here's our kind of value proposition. Maybe here's our traction. Here's a little bit about the team, stuff like that, just to give them a little more information. But keep in mind that you've done your research up front. This person's a great fit. And, the only reason why they would pass is on the business itself. And the only way they're going to figure that out is by you sharing information about the business. So really, whatever you're comfortable sharing, I would go ahead and share it. The thing I like to think about is if that VC comes back and the first thing they're going to ask for is a pitch deck, maybe it's just more efficient to attach it initially. Kind of as I said before, great investors are in the business of confidentiality and reputation. And if you've done your research up front, these are people that you think you want to work with. You've probably seen, okay, are they reputable people that I can trust? If so, maybe you're a little more open to sharing some documents. But certainly a good cold email that has a decent blurb about the company, if that's all you're comfortable with sharing, that's okay too. But just be prepared for them to come back and ask for that pitch deck or some more information. Some fantastic questions here, folks. We still have some time on the calendar here. If there's anything else, please, share it in the Q&A or in the chat. Is it better to have issued stock prior to a pre-seed round? So I'm assuming in sense of actually almost like incorporating the business and getting the shares issued to founders and maybe even doing an ESOP. And the answer is yes, but you have to do it right. So you want to make sure whatever legal counsel you're working with has experience working with startups who become venture backed, right? Because they're going to structure your company in the way that makes it easiest to do a pre-seed round, right? You want to get all your ducks in a row from a legal perspective prior to raising money, because if you don't, it's going to drag out the closing process, right? Getting to a term sheet is one thing. Going from a term sheet to money in the bank is a completely different other process. So it's best to have all your legal ducks in a row, all your due diligence ducks in a row before you start going out and raising money. And you want to make sure you're doing that with legal counsel who understands venture-backed startups. Should you continue to send monthly updates to funds, even if they aren't responding, to show continued growth and achieving goals moving the company forward? It's a great question. And I would say it's really up to you. Excuse me. Some funds just might not reply for whichever reason. If you think that they might be a fit, you can certainly keep it going as well. But, it might also be one of those things where they're just in it for information and optionality. If you're starting to disclose pretty confidential information, then maybe you can start to remove folks who you don't think are interested. And after you raise a round, it's always good to go through that list and refresh it. So if you raise your pre-seed round, maybe, you can take off the pre-seed investors who didn't pass. Keep the multi-stage folks because maybe they might do your seed or series A, and you want to keep them informed, but it's always good to refresh it every now and then. That way, a couple of years down the road, you just don't have a list of like 1,000 VC firms getting updates about your company. So curious about dynamic splits, like using Pie Slicer. I'm familiar with Pie Slicer, but I haven't seen it in practice in a startup that I've looked at yet, and I'm not familiar enough to comment on it, unfortunately. But what I will say is these dynamic equity models are very interesting, and I think it can solve a lot of problems, maybe at the founder level, in terms of equity split and whatnot. We always advocate for vesting in our companies. So all the deals we do, the founders will have reverse vesting, if you will. So it might be like a 4-year vesting plan with that 1-year cliff. And that's to kind of protect if, founders decide to leave the company, they don't leave with like 25% of the business, if you will. And I think these dynamic equity models try to solve that problem in a bit of a different way. So I'm sure there's some merit to it, but I don't know enough about it to specifically comment on that method. Yeah. So this cap table question is fantastic. So the question is, from what you've seen with startups, how do they keep their cap table in good shape? Perhaps you've seen some bad ones that have kept you from investing. Cap tables can really, really, really be a train wreck if it's not done properly, especially the due diligence process. Like we said, getting to a term sheet is one thing. Getting to money in the bank is a different thing. So tools like Carta are fantastic. There's a couple competitors to Carta now in terms of cap table management. They're a really, really great way to manage all of that. And I believe some of these cap table management tools have free plans or very cheap plans for startups. So those are great to get onboarded with early, and then it just makes your life so much easier. It's a single source of truth for your cap table. You don't have V1 through 10 of Excel models floating about that maybe have a wrong cell calculation in there, especially if you're raising money from angels. I've seen cap tables with like 60 lines of different angels and different VC funds, and that was a challenge to make sure everything was done correctly, if you will. So these cap table management tools are fantastic. In the earliest of days, if it's just like 2 founders, then your spreadsheet is really maybe all you need. But once you start raising money, hiring employees, managing stock option pools and whatnot, then moving towards a more professional cap table management tool might be the best move for you. And then we have, what are some red flags from founders and founding teams that make you run away from investing in them? There's plenty. I would say initially it's a lack of understanding on maybe what it means to raise venture capital, or maybe what they need to do to kind of do that. If they think it's a simple path and that, all we have to do is just invest the money and away we go and it's all going to be great, that's usually tough to get a deal done. Or even companies that just structurally aren't set up to take venture. So maybe the company isn't a corporation, maybe it's some sort of partnership, and the share structure is weird, and just getting a deal done might be a bit of a pain. Then that could be tough as well. But there's plenty of things that, can make it challenging to move forward with an investment. Okay, so it looks like we've come to the end of our Q&A. This was fantastic. If you have any other questions, feel free to find me on LinkedIn, connect with me there, send us an email here at Concrete Ventures. Love to chat with all of you folks. So I'm going to send a follow-up email shortly after this kind of ending here, and then I'll include kind of the recording, the slide deck, and maybe some other stuff. But if there's nothing else, then enjoy the rest of your day, folks, and thank you so much for taking the time to join us today.